Good afternoon, ladies and gentlemen. It gives me great pleasure to participate in the Africa FinTech Festival for 2021. As I mentioned to other colleagues, I truly think that this is the opportune time for Africa to shine, and financial technology, FinTech as it's more commonly known, is the perfect catalyst for us to accelerate. The first perspective is the potential of FinTech to contribute to growing economies like our economies in Africa. And the second is that of the regulatory perspectives and the issues the regulatory authorities are facing trying to grapple with this phenomenon of FinTech. Sometimes the approach to FinTech reminds me of an old joke about the man who is standing under a streetlight looking for his keys when another man offers to help him. The helper asks, "Where did you drop them?" Upon which the man replies, "Across the street." "Then why are you looking for it here?" "This is where the light is better." When the only tool you have is a hammer, everything certainly may look like a nail. And this perspective, I think, goes for both regulators and industry players. We have to continuously sharpen our saws. FinTech is not going to answer each and every problem or issue that we are facing within financial services. Nor is FinTech provided and should it not be used for regulatory authorities to strictly implement burdensome regulatory approaches to all financial services activities. I think this certainly calls for a balanced approach to FinTech. I think somewhere there is room for a cohesive and balanced approach to unlocking the huge potential that FinTech has. If I start off with looking at the evolution of FinTech. So over the last decade or so, financial technology has certainly attracted attention from many parties across the spectrum of innovators, regulators, policymakers, and academics. And with these different parties, two main schools of thought have emerged on this phenomenon of FinTech. The first sentiment argues that this type of innovation is evolutionary and it's not different to what we've experienced in the past. Proponents of this school of thought comment that these innovations are likely to just integrate with the existing value chains and business processes, which will result in a symbiotic relationship developed between FinTech firms and incumbents. However, a different perspective have also emerged that have suggested that FinTech offers revolutionary changes which may displace the traditional intermediaries that we are certainly known with. This emergence of FinTech could be associated with the theory of dynamic economic growth, or what the economist Joseph Schumpeter referred to as creative destruction. This refers to the process of industrial mutation that revolutionizes the economic structure from within, incessantly destroying the old one, thereby incessantly creating a new one. With the advent of FinTech, traditional financial services are being rearranged in a bespoke and novel way around its consumers. Innovations such as peer-to-peer lending platforms, alternative mobile payment platforms, crypto assets, and initial coin offerings has shown it does possess the ability to disrupt existing financial services and products market. These new type of financial services providers tend to be the non-banks or even small non-banks with small or even negligible amounts of capital, but certainly they have the nimbleness and customer appeal to compete against these traditional market makers. Globally, many startups have spent a lot of time and resources on various alternatives to traditional banking, with a specific focus on bringing about innovative solutions that challenges the existing financial services offerings. Some research, if I look at the global Findex database of 2017, already showed that 515 million adults worldwide have opened bank accounts at a financial institution or mobile money provider. Thus, globally, 67% of adults have bank accounts. Although this seems high, globally, there's still 1.7 billion adults that remain unbanked. This means they have no account held at a financial institution or even a mobile money provider, and they are typically situated in developing countries. In high-income economies, 94% of adults have accounts, whereas in developing economies, it's only 63%. This, I think, certainly provides further impetus for these new players to come up to the fore and fill these gaps that still remain after so many interventions, so many actions by different players, that these gaps still remain. And I think some of these fintech solutions can provide answers to some of these questions. According to some studies, fintech is expected to contribute at least between between 40 billion to 150 billion to sub-Saharan Africa's economic output by 2023. How can this be achieved? And I want to mention some global country examples of how digitalization has acted as an enabler for these economic development and growth to suffice. So the first country I want to use is Estonia, a country leading the charts in embracing fintech and setting the pace towards the digital economy. I think this sort of epitomizes what Estonia has achieved in a short space of time. They have introduced e-identity, digital signatures, e-residency, and i-voting. The Estonian Entrepreneurship Growth Strategy 2020 outlines the strategy for the Estonian economy for the next 7 years, focusing on 3 main challenges in order to increase the wealth of Estonia. Those three main challenges are increasing productivity, stimulating entrepreneurship, and certainly encouraging innovations. And I want to provide some anecdotal evidence of how they have achieved this so far. If I look at savings and efficiency, at least 2% of state GDP is saved due to collective use of digital signatures. 840 years of working time is saved annually thanks to just using data exchanges. The time to establish a business has been reduced from 5 days to 18 minutes. Astonishing. Other indicators that I can mention to you is 98% of companies are established online. 99% of transactions are done online. 95% of tax declarations are filed online, and this only takes three minutes. These are just some of the examples of how a small country can gain competitive advantage by embracing digital enablers that lay a foundation to rapidly move towards this digital economy we've all been talking about. If I move to a different country, if I take Singapore, I think there's certainly another example, a great example of what a country can achieve. Singapore has adopted the Smart Nation policy, which means that they embrace technology in all their processes and encourage technological innovation and adoption. The Monetary Authority of Singapore has identified 10 enablers to shift towards the digital economy. One of it, and similar to India and Estonia, is the ability for citizens to store their basic identification electronically. In Singapore, this initiative is called MyInfo. MyInfo is a one-stop data repository that saves time in not having to capture basic information over and over again. It is a single online personal data platform. It includes your personal information, such as unique identification number, name, gender, age, and etc. And it can include other additional info like education, for example, employment, and could include income information as well. Such access can enable quicker completion of digital online artifacts by accessing the APIs, application programming interfaces of MyInfo. The Monetary Authority of Singapore also released its industry transformation map for financial services. So there's this coherent approach, plan, and strategy to digitalize the economy and financial services. Their vision is to be a leading global financial center in Asia. This aims to achieve real value growth of 4.3% and productivity of 2.4% annually in the financial sector. Then if I can use one more country example is China. Certainly we've known of some of the achievements of China as well, specifically relating to digitalization. And in China specifically, it has led to the reshape of financial services as they have known it. Almost a decade ago, Chinese e-commerce retail transaction value accounted for less than 1% of the global value. This figure has now risen to more than 40% as a result of efforts from giant fintech companies like Alibaba, Tencent, and Baidu. In 2016, mobile payments for goods and services in China totaled over $790 billion, 11 times more than what is done in the US. Research that was done by the International Monetary Fund shows that a 1 percentage point growth in digitalization of China's economy is associated with a 0.3 percentage point growth in its GDP. The examples of these different countries that I mentioned, Estonia, Singapore, and China, certainly signals the potential of fintech and the shift towards this digital economy. They are examples of how industry players providing digital solutions with the support from government and central banks and regulatory authorities, what they can do to create this enabling environment for fintech. There are predictions that these efforts can add significantly to GDP of an economy, as I've mentioned in China. Some of the estimates that's been calculated is between 0.5 and 1.5% of GDP, just as a result of this phenomenon of digitalization and harnessing what fintech can provide us. Therefore, I think you can't only focus on the technology itself. Fintech players can provide the solution, but it's certainly up to government and regulatory authorities to play their part as well. I think what's seen from these different countries is that what works best is a cohesive approach of government, the continuous will of innovators to solve problems, and of course regulators and central banks coming up with policies and laws and regulations that are enabling for these innovations to happen. So if I now concentrate on the role of the regulators, While this digital revolution may, for instance, result in improved financial service offerings and also increased financial inclusion, certain risks are introduced as well, which may not be fully covered by the existing regulatory safeguards that we have. These safeguards are developed over years of in-depth analysis, understanding, and implement the appropriate regulatory measures. So what are the issues that regulatory authorities are facing? We certainly can agree that fintech will reshape financial services. Regulatory authorities are forced to focus and dedicate resources to fintech developments. Understanding this shift is crucial. For regulators and policymakers, the main concerns arise not only from the technology itself, but how it affects the delivery of financial services, along with the accelerated speed of development. Regulators therefore play a crucial role in creating this enabling environment for these innovations to excel, but in a responsible manner. Regulators can no longer wait for innovations to mature in order to develop appropriate frameworks to assess the implications. But now, as I would think, they have to learn and adapt as these innovations progress. The age-old saying of regulations will always lack innovation probably still holds true, but I think the pace and the gap that exists between regulatory action and innovation should certainly be narrowed so that enabling regulatory frameworks are implemented. Its implications for policy considerations such as market structure or financial services. If we look at competition, composition of the different financial market and the concentration in financial market, the efficiency in providing financial services and the related potential to deepen inclusion makes it a relevant phenomenon. Its potential impact on financial stability is largely unknown, but further risk may evolve. If I just briefly mention some of the innovations in specific financial services activities, if we look at new forms of money or stores of value, there we can look at the issue of cryptocurrencies like Bitcoin and I think 3,000 other different types of crypto assets that has evolved. Certainly, as people become more familiar with this concept of virtual currencies, and it's more adopted more often and more frequently, the traditional currency issued by central banks still has the advantage, though, that it's issued by a trusted third party. But this conceivable effort that other parties may emerge as a result of this phenomenon can certainly be acknowledged. I'm certainly run out of time. The other financial services activity that I just want to mention is payment. In payments, where you see phenomena like Apple Pay, Samsung Pay, the lending market, where you can now access online peer-to-peer platforms or equity crowd-based funding platforms, certainly has provided lots of other opportunities for financial services to be delivered to previously not access markets. So I certainly think there's lots of opportunities for regulators, for innovators, and government to team up and come up with these new solutions. In summary, I would like to say that fintech innovations can certainly be seen across financial services activities like payments, lending, investments, and deposit taking. But in-depth analysis of these activities rather than the technologies of firms are required to understand these developments. New technologies will continuously present opportunities to reshape financial services and the underlying activities opposed to the ever-evolving technology that needs to be understood.